Mark Fuchs. He's the CEO of Fuchs Capital Partners, an equity long-short hedge fund focused on Southeast Asia. He joins us on set as our guest host for the next half hour of the show. Mark, good to see you and good morning.
Good morning.
Talk to us. A lot of news flow. Lehman about to go to the wall. Barclays fell apart. Bank of America's not interested. It prefers Merrill Lynch instead. The Fed say, look, let capitalism work itself out. Let this guy fail. How worried are you?
Well, actually, it's funny how the market seems to be focused very much on Lehman and what's going to happen. Will it go bankrupt? Will it not? I see very much the Lehman situation as very much a symptom of a problem, not the actual cause of a problem. So whether they go bankrupt or whether they're saved is not the issue. The issue is essentially that you've got unemployment rising in the States. You've got delinquencies in terms of housing at record highs since they've kept the record since 1979. You're at the highest level. If people are failing on their house, you can bet that they're probably failing on their credit card and they're probably failing on their auto loans as well. So you've got a fair amount of loans that have yet to be fully reflected in some of the problems beyond that of housing. And so if Lehman is in trouble, which it seems that they may be, it would be logical to assume that there's many other institutions whose risk systems are less sophisticated that may be in further trouble.
I mean, how long is this going to take before it sorts itself out in the market if what you're saying is that essentially, even if we get resolution on Lehman, whatever it is, that fundamentally nothing has changed, and in fact, fundamentally, maybe even things are getting worse?
Yeah, I mean, typically these issues take years, not quarters, to resolve. So I think it was wildly optimistic of the market when we saw the bailout of Fannie and Freddie to have done what it did, especially in Asia, let alone in the States. And you've got relatively ambitious valuations right now in the States. It's roughly on about 15 times. Most people are looking for 1.5% growth in the States. I've seen downgrades now to 0 to 0.5%. So I think that that's probably maybe reflective of further downside to global markets, let alone in the U.S.
What about out here in this part of the world, specifically Southeast Asia? You're setting up this equity long-short hedge fund focused on Southeast Asian equities. Timing?
Yeah, well, I mean, fortunately as a hedge fund we can go short as well as long, but actually one of the things that's interesting about Southeast Asia is that its correlation in terms of economic growth to what goes on globally is much lower than that of the more developed markets globally and also within Asia. So, for example, Korea, Taiwan, arguably China are to some extent greater proxies on what's going on in the U.S. than in more domestically driven discrete consumption markets such as Southeast Asia. That said,
it's been sold down just as much as some of the North Asian markets.
That's right. The distinction between correlations on economic growth and market correlations are very different in the short term. And the problem for Asia, and this isn't just Southeast Asia, is that when people are taking risk off the table, they tend to take it out of emerging markets far quicker than they do in developed markets, rightly or wrongly. Yeah. The epicenter thus far is in the States, yet arguably that market's only down about 12 to 13%. Asian markets are down anywhere from 25 to 45%.
Yeah, I mean, what we're hearing basically is, a lot of money is being pulled from EM, including EM Asia, repatriated to the U.S. One of the reasons we've seen the dollar so strong the last 2 months or so. You were talking about not so much correlation between what happens in the West and the U.S. and Southeast Asian markets. I mean, the rule of thumb is whatever happens in the U.S., it's amplified about 1.5 times out here in Asia. But Southeast Asia, that subset, what is specifically the correlation?
I mean,
put a number on it.
Well, it depends on the market, but the less correlated markets, so for example, Indonesia and Thailand, the R-squareds are something like around 0.3 as opposed to, 0.5 to 0.7.
Oh, okay.
There's another angle that we haven't really talked about, and that's the political angle. Because even if, as you say, economically speaking, they're perhaps a little bit more decoupled than the markets are, politically speaking, in areas such as Malaysia and Thailand, it's a real minefield. Would you really be looking at them in light of that?
I think again we have to separate the short term from the medium term. I think there's a reasonable amount of value in places like Thailand, but nevertheless there is political constraints and headwinds in the short term, both in Malaysia and in Thailand. But remember one thing, and this applies to all of Southeast Asia and to some extent Asia, the surpluses in terms of fiscal surpluses, the current account surpluses, the foreign exchange reserves, which in many cases are, even in Thailand's case, is larger than that of Switzerland or Canada, allows a huge policy response in the form of lower rates, in the form of even lower taxes. So I think in the short term, it's absolutely correct to assume that markets will remain under pressure. In the medium term, I think that the fundamentals will assert themselves.
Okay, we'll be back with you in just a second. Mark Fuchs, CEO of Fuchs Capital Partners. Joining us there in Singapore, just ahead, oil falls below the crucial $100 a barrel mark. We're going to ask Commodity Warrant Australia if the commodity super cycle is over. That is next.
All right, to markets, quick snapshot. Here's how we're shaping up so far this Monday out here in Asia. Sydney is down almost 1%. Wellington is down 0.7 there. Kiwi stocks extending losses in Sydney, of course, which opened up just in the money, has now turned tail. Okay, let's get back to our guest host, Mark Fuchs, CEO at Fuchs Capital Partners, staying with us here on set at our Asia headquarters. You know, we were telling folks a couple of minutes ago that, look, you are setting up an equity long-short Southeast Asia focused fund, and we were going, look, timing with all this stuff going on with the weak fundamentals in the U.S., et cetera. But, I mean, in the industry that you're in itself, July funds got killed. August was even worse. You've got redemptions. You know, you've got, you know, a change in the investor base, endowments, pension funds, et cetera. They're more likely to go for, let's say, funds of funds, and that basically means more costs and mediocre returns. This is a tough business to be getting into, and at this time.
It's a very tough business at any time, and particularly this time. But then again, I think most businesses in this area would be tough, particularly investment banking and whatnot. I would say, though, that remember, over the next 5 to 10 years, you have major funding gaps in relationship to pensions, which are coming due. You've got demographics in the States where the bulk of the population, in the form of the baby boomers, are indeed looking for to meet that shortfall in pension obligations. As such, the alternative investment space structurally will continue to see inflows. And I would also argue that notwithstanding the problems that we're having over the next 1 to 2 quarters or perhaps the next year, Asia, and for that matter international funds, will probably see net inflows. When you look at market cap to GDP, the U.S. is something like 27, 28%, 30% at most. The allocations are still overweight the U.S., and you go to many state pension funds in the United States, and you actually have a zero allocation internationally. And I think that that will present problems medium term to meeting that gap. So alternative investments provide not only enhanced returns, but more importantly, idiosyncratic exposure, non-correlated returns. And at least in our fund in Southeast Asia, we are looking at much lower correlations in terms of the developed markets to what we see in Southeast Asia, which are more domestically driven consumption stories.
It just seems so hard to make a buck, though, these days. I mean, almost every single asset class is moving to the downside. I mean, you know, what would you be telling people right now who are really worried about their hard-earned cash just dissipating into where?
Well, you're right. It is hard right now in the markets, and I think that you're really looking at a situation where in the next 1 to 2 quarters, it's wildly optimistic to assume that markets will actually do better. And I think that caution is probably warranted. I think that valuations are not fully pricing in the kind of disruptions that we've seen in the capital markets.
When you say caution, what, just putting your money in cash? I mean, what about some of the other traditional safe havens? Like, could potentially some of this U.S. financial fallout mean that gold as the traditional safe haven benefits? We're already seeing gold and silver up by about 2% in trade this morning. I
actually like gold. I think that when you look at the marginal cost of production, it's not far away from where the price is now. If you look at the overall increasing demand medium term from India and places like China, coupled with the financial instability, I think medium-term gold is actually a good place.
Thank you very much for joining us today. Mark Fuchs, CEO of Fuchs Capital Partners, who's been with us for about the past hour or so. Well,